This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. Remember when you tried to pick mutual funds from a list in your employer's retirement program? You always felt limited by the available choices, you questioned the fund's top holdings, and maybe even wondered about the manager's skill, commitment, and incentives. Even with innovations like target date funds, you felt locked into somebody else's ideas about what blend of investments and risk versus return would achieve that goal. I always thought they must be structured like an annuity where they would guarantee a safe 5% annual return while they used the balance of the money for riskier growth ideas. Thankfully, innovation is accelerating in Fintech. That's sort of the hashtag, so to speak, for the field of financial technology. We have a company called Betterment. I'll just read from this quick description of Betterment from their site. The Betterment portfolio is designed to achieve optimal returns for your investment goals through diversification, automated rebalancing, better behavioral guardrails, and low fees. The behavioral aspect is what you're seeing come in. Behavioral guardrails, I would assume, would be people making drastically big decisions that could be wrong, like taking too much risk for too short a time horizon, or taking the money out of an IRA and facing penalties to use it in the short term when that's not going to achieve your goal. So maybe that's what they mean by behavioral guardrails. The Betterment approach to long-term investing can help generate 2.66% higher returns than the typical do-it-yourself investor. And obviously they've run some sort of calculation. Maybe it's got back testing so that they can claim that you can do 2.66% better than doing it yourself. They continue, our technology helps make this possible by lowering taxes, lowering fees, diversifying your portfolio, and enabling better investor behavior. Now, it seems like if you did all those things, lowering taxes, lowering fees, diversification, and sort of warding off bad behavior, dumb mistakes that people make with their money, which we talk about all the time here, that you could do a lot better than just 2.66% better. But I just wanted to bring up Betterment as one model that's out there. We're not going to deep dive into them today. Maybe we will on a different show or have one of their team members on. Then there's also Wealthfront. Wealthfront, I'll read again from their website. Our investment strategies may be sophisticated, but our philosophy is simple. Technology can do some things better than people. Okay, pretty straightforward. We use software to better execute time-tested investment strategies, and this allows them to reduce risk, reduce taxes, and reduce fees. Sounds pretty similar to Betterment in that approach. And they continue with a pithy line here. Fortune favors the smart, not the bold. Picking stocks and chasing market fluctuations may be exciting, but when it comes to long-term investing, you can't expect to outperform the market. Even Warren Buffett would agree. My first reaction there is that, Warren Buffett would agree that probably index investing is the best thing for somebody who's not actively managing their money, and picking stocks is hard. He's, had some incredible success over his long career, but he, follows a certain methodology, and he'd be the first to admit that for every home run, there's quite a few strikeouts. Let me read something more from Wealthfront here, because it ties into the next place I want to go. We believe in passive investing. This simply means parking your money in a diversified portfolio of low-cost index funds and having the patience to stay the course. It was a radical idea when economist Burton Malkiel first introduced it. But academic research and time-proven results have confirmed it works. He's a smart guy, Bert. So smart, we made him Wealthfront's chief investment officer. Now, I did not know that until I just read that today, so that's pretty interesting. Now, I know a little bit about Malkiel, so this is where it gets interesting for me. While I like the idea of people having more choices to grow their retirement savings, I am also a very active investor, a stock picker, and a trader at heart. as are most of the followers of my newsletters here at Zacks. At Zacks, we have a portfolio of over a dozen different newsletters with different investing styles and different managers, and these are model portfolios. We don't manage anyone's money. We give investment ideas. We pick stocks, and people can follow along or choose not to, but a lot of people do, and they like our ideas. They want our ideas, and so this is a very active thing we do here with these model portfolio newsletters. So if you don't know who Burton Malkiel is, he's the author of a philosophy that runs counter to my beliefs, that the markets are too random for a stock picker to succeed, and that you should invest in index mutual funds. This is from Wikipedia. Burton Gordon Malkiel, born August 22nd, 1932, is an American economist and writer, most famous for his classic finance book, A Random Walk Down Wall Street, now in its 12th edition as of 2015. He is a leading proponent of the efficient market hypothesis, and the abbreviation for that, the acronym is EMH, and that is the thing that active investors and traders and stock pickers like me do not believe in, that the market is efficient, and we capitalize on inefficiencies all the time. The EMH, efficient market hypothesis, contends that prices of publicly traded assets reflect all publicly available information. Although, I guess in recent years, Malkiel has also pointed out that some markets are evidently inefficient, exhibiting signs of a non-random walk. Malkiel, in general, supports buying and holding index funds as the most effective portfolio management strategy, but does think it is viable to actively manage around the edges of such a portfolio, as financial markets are not totally efficient. Okay. Well, in this episode of Mind Over Money, we're going to focus on a new platform called qplum. Q, the letter Q, all one word, P-L-U-M, and it's all lowercase. I learned more about qplum through the NVIDIA AI podcast, episode number 26 from June of this summer, June 2017, where host Michael Copeland interviewed co-founder Gaurav Chakravorty. The NVIDIA AI podcast seems to be where I learn a lot of new things these days. And that's not just because I'm an NVIDIA investor, but also because I'm fascinated with AI and deep learning and how it's changing technology and society. Copeland he and I started our podcast around the same time in November of 2016. He's got about 40 episodes on me now, and I think I'm just getting over 22 myself. So hats off to him for being more dedicated. He does a fantastic job. Michael Copeland is a longtime journalist based in Silicon Valley, and he's been in the thick of technological change since the web took hold. So the AI podcast, it's called, from NVIDIA is must listen. So put it on your list of podcasts to check out. Every episode may not be of interest, but many of them are. And I've been going back through all 40 of them and listening to several of them. All right, so qplum claims that investing can now be a science and not a game. Well, that's no fun. I enjoy the game, and I take issue with thinking it can be a science. More on that coming up. To achieve this goal, they are using dynamic AI strategies and protecting against downturns. Sounds good. Sounds interesting, at least. All right, but before we talk about the exciting AI-powered investing of qplum, I want to make sure you have some resources that I only briefly mentioned at the end of last week's episode about deep learning. One was the Time magazine article about helping college students and educators become robot-proof. And I had lost the reference at the time, but it's an article by Joseph Aoun. His last name is spelled A-O-U-N. And I forgot where he teaches, but in my Twitter feed, you can find the article. I've retweeted it several times. So, Robot Proof: Higher Education in the Age of Artificial Intelligence by Joseph Aoun. How college students should prepare for our automated future. And it's on time.com. So that was one resource I wanted to make sure you had. Good stuff in there. I also mentioned a new book by Max Tegmark, who is a physicist at MIT. And the book is called Life 3.0, about a 300-page book where he's looking at being human in the age of artificial intelligence. And as I had a chance to read some chapters in the past week, I came across his experience with Elon Musk of Tesla. And you may have heard Elon Musk talk about artificial intelligence and sort of be, a Cassandra warning of some of the potential dangers. And I think he's right to do that. I mean, first of all, he's building a business that's going to capitalize on many AI technologies. So he's not against AI. He just is pointing out where it can be misused. And there was actually, over the summer, I think there was a sort of a Twitter flap between him and Mark Zuckerberg of Facebook where they were taking shots at each other. And it was it wasn't really that they were meant to go out of the way to take shots at each other. It's that somebody on Twitter was stirring something up and it got them both going. And, well, Zuck says this and Elon says this. And Elon kind of threw out one barb and said something like, I've talked to Mark about this. He and implied that it wasn't Mark's area of expertise. And that may well be true. What I found is sort of some more of the backstory here is in Max Tegmark's book, Life 3.0, on page 37, he talks about a conference that he was at with Elon Musk back in January of 2016, where they brought together just a huge assortment of scientists and engineers to talk about AI and to sort of address this issue of, safe AI. And so they held a meeting in Puerto Rico, by the way. So this was an important meeting that happened, this is a long time discussion. This is something that Musk has been focused on, not just building AI, but also talking about safe AI and where, the dangers might be of, certain systems in the wrong hands, being allowed to do the wrong things. So if you want to learn more about that, definitely pick up Max Tegmark's book, Life 3.0. All right, the last resource I wanted to make sure I share before we take a quick break and come back with dive into qplum is also about Tesla. And this ties into my philosophy as a growth investor, an active investor, a stock picker, and doing your own homework, doing your research. I will tell you that a year ago or so, I was bearish on the stock of Tesla when Elon Musk went and bought his own solar company, Solar City, bought it, and it almost seemed like to save it and brought it within the fold of Tesla. I thought that was sort of a desperate move where he was bailing in Solar City. So whenever you see a CEO or a company do something that seems desperate and you question their motives, like he's bailing in his own company, you're not optimistic about the growth or the management or decisions. And I thought at $200 that you shouldn't buy Tesla, that it could go back to 140 like it had done in 2016 once already. And some big banks agreed with me. Goldman Sachs, Morgan Stanley, they were downgrades. Price targets went to below 190. So I thought, oh, okay. And since then, I mean, Tesla has done nothing but go up. I mean, it got back up to its old highs near 375, and it's still holding above 300. And what I didn't fully understand was where the growth of Tesla is going to come from, how they're going to drastically increase sales and potentially become profitable in the next year or two because of the new Model 3. They make two luxury cars, the S and the X, which sell between $70,000, $80,000, but the Model 3 is going to be a more affordable car, electric car, and hopefully has the same quality that Tesla drivers have come to know and love, but be priced in the mid-40s. So this is going to be their launch into the mainstream. They'll be able to sell more cars, and so the estimates are that, hey, they're going to launch this thing, and their goal is to make 500,000 cars a year eventually. And, this will ramp their revenues, into the tens of billions and create a profitable company. Now, Elon's his vision is not just to build a car company. He wants, he's trying to change society and technology by making the electric car a vital part of society and technology, and the batteries he creates, and just he's trying to create an ecosystem too with solar homes and that sort of thing. So lots to learn from him. And so this is an example of how I did my research and I got a growth story wrong. And I would consider being a Tesla investor, not at $325, but definitely on pullbacks. The stock fell down from its recent run up to the old highs near 375 because they didn't produce as many Model 3s as they thought they were going to. Maybe it was, between 5 and 10,000, or no, actually it was less, but when is the real ramp up going to happen? And so that's sort of called into question because they need to show that they can start producing, tens of thousands of these cars every quarter to keep those sales forecasts, in line, where you have some analysts think that it's the stock should, is going to $400 or it's going to $500 because when they start producing these cars and selling them in mass, tens of thousands a month, that this is sort of the lever that turns the sales and the profits. So if they're not producing the cars, then that's not going to happen. So in my article, every time I do a podcast, I always write an article and publish it on Zacks.com with the podcast and the article together. I will link to my article on Tesla, where at the time it was a bear of the day feature because estimates were going down. But I also talked about, hey, when they get this right, here's the potential for big sales and profits because of the Model 3. You can go to Zacks.com and just search the stock symbol Tesla, TSLA, and look for my bear of the day article by Kevin Cook. All right, I will be back in a moment, and we're going to dive into qplum and its quantitative investing methods. I will be back faster than you could spell AI-powered quantitative investing. All right, so we're talking about qplum, a new investing platform that's powered by AI, and I listened to a podcast, the NVIDIA AI podcast, where Michael Copeland interviewed the co-founder, Guarba Chakravorty, and just it was very exciting listening to it. There were some things I disagreed with, and we'll get to those, but let me just describe the company in their own words from their website. Our investment beliefs. We believe in the mathematics of data-driven decision-making, the science of behavioral economics, and the art of effective communication. These pillars of qplum help us curate strategies that meet your investment goals. We use quantitative trading techniques and invest using data and machine learning. Our investments are based on time-tested ideas such as momentum, trend following, risk parity, volatility, and more. They emphasize strategies, not products. We utilize the best practices and processes of institutional investors to manage your wealth. Rather than making one or two great predictions, we expose the portfolio to many growth opportunities. Our portfolios invest in stock, bond, and real estate ETFs. These ETFs are liquid, diversified, and low cost. And you can see the list of ETFs on their site. I did not look at those, but I'm going to as soon as I get off this podcast. I continue here with qplum's description of their philosophy and approach. We create a mandate, discover your risk profile, and invest in strategies tailored for your set of needs. Our strategies make sure that you save tax on your investments. We execute algorithmic trading, which results in higher portfolio returns. So again, like the other ones, lower costs, which has just been this massive trend in financial markets for the last 20 years with electronic trading and the internet and these firms competing to, brokers need to, they make money off of the balances in your account too. They want to have a lot of funded accounts because the higher the balances, the more that they can do in financial markets. So, but then since they're all competing, they're all lowering their costs. That's why you got people offering you $3 stock trades. I'm going to talk about one firm offering free stock trades in a moment. All right, last thing that I want to read from the qplum website is about risk management. I found this interesting. Risk management answers two questions that every investor asks. When do I increase risk, and when do I stop everything and exit? With qplum, you don't have to answer these tough questions on your own. Our risk management engines optimize your risks and protect your portfolio from market crashes. Your crisis plan is in place before you need it. Now, that might be one of the strongest selling points. I opened in the beginning talking about having your money in, picking mutual funds and then picking some sort of target date strategy. Well, the firms that are offering those don't have a formula where they say, hey, we're going to get you out of the market before there's a potential crash or something like that. Now, I'm not saying that anybody who attempts to do that will get it right, because who knows? In the earnings recession that we had in 2015 and 2016, where we had 5 or 6 consecutive quarters of earnings, negative earnings growth, so to speak. That's what's called an earnings recession. But the economy was not in recession. But there were many fund managers, famous people and not so famous, saying, hey, this economy could tip into recession. Even if the stock market goes lower, it could drag the economy into recession. So, if one of these models would have taken you out of the market in 2015 and 2016, you would have missed, the fantastic rally that we've had since the summer of 2016. The past 18 months have just been a great time to be a growth investor. And that's what we've done with many of the newsletters here at Zacks. So if you go on their site, you'll see they have 4 primary strategies, and they all seem to be based on risk appetite and time horizon. And then I think you choose one if you're going to sign up with them. But definitely something to explore. I think that for me, when I think Betterment and Wealthfront obviously are better solutions for some people than were available 10 years ago. But for me, qplum is one of the most exciting, because I think that what the founder is doing with AI is going to lead to more innovation. I think he started out with this first level of offerings, and I think that it's going to evolve over time, because he'll be able to see what he can do with AI. And listening to him talk, I know he was a quantitative, I believe his PhD was in computer science. So, he was already doing machine learning and deep learning, and then he took a finance class at Wharton in, I want to say, 2005. And then that's where he became involved in finance, because he thought finance was too messy for machine learning. But then he started to see how he could sort of tame the data if he just had enough data. And what I found interesting is that he started out with a very, very short-term model. He was doing high-frequency trading in his first machine learning programs, and he was trading government bonds, U.S. government bonds, and taking in all the data that he could. And I don't know where he got the computing power to do this, but then he was trading bonds in 30-second to 600-second time intervals. So, definitely high-frequency trading, and he was having tremendous success with his model, the way he trained it. So that's what machine learning is. You take a data set and you train a machine. What can it learn from this huge data set? And I think he said he used 4 years of data. And then once you've trained it on a historical data set about what patterns to act on to buy or sell in this very narrow time window, then he unleashed it. And apparently he was doing huge volume in the government bond market and having fantastic returns. But again, this is a very short-term time frame. So when in the NVIDIA podcast, if you're thinking that somebody would told you, hey, qplum is this new investing platform where you can manage your retirement, you'd be thrown off, because in the NVIDIA podcast, they spend the first half of the 20-minute podcast talking about his short-term model, trading government bonds in 30-second to 600-second time intervals. So that's why I wanted to read about his website and show you that, they've got strategies they're offering to the public for managing retirement savings and people who are trying to grow their wealth. And the other area that he's going to be able to innovate in, and I'm going to see if I can get him on as a guest on the podcast here, because I think that we'll have a lot of fascinating things to talk about, especially when it comes to the behavioral aspect, is that he's offering solutions and strategies to institutions. So one of the cool things that Gaurav talks about is that, hey, quantitative investing, and even now applying AI and deep learning, has sort of been the space where only a multi-million-dollar hedge fund, and when I say multi, I mean hundreds of millions of dollars in assets under management, is sort of the bar that you had to have that size of firm to be able to hire the quants and the programmers to do this kind of research. And what he's trying to get away from is saying, hey, no, I can make these tools available to the average investor. And there's even the thing to talk about where your big hedge funds, if they're hiring a bunch of quantitative people, and I've seen this for over a decade now, they're hiring, mathematicians, engineers, physicists to create models that they can trade off of. Those are still very influenced by humans. Those are quant models created by quants, which isn't AI. So he's saying that, here's the next evolution where now hedge funds are also realizing they can apply the deep learning that's going on in Silicon Valley or Boston or even Chicago, and now create AIs that can even outdo the quants. So, but he's trying to bring that to the people, so to speak. So I think I've given him a fair shot here talking about his firm. And now I want to just point out a few areas that where I might disagree or that concern me. One of them is he says, okay, the financial industry is a $164 trillion industry. Now, I'm not sure where he gets that number from. I know that there's $80 trillion in assets under management in all, like the top 500 funds, managing both stocks and bonds. There's, over $80 trillion. And then obviously you could have trillions more in people's personal accounts that are just held at, say, a broker like Schwab or Scottrade or E-Trade. He says, hey, well, we're paying $1 trillion in fees. Now, $1 trillion in fees sounds like a lot, but on a business that size, I mean, if, wherever that 164 trillion number comes from, that's less than 1%. I mean, there are people who make their living in finance, whether it's because they're a broker helping you execute trades, answering your questions, and doing it for dirt cheap commissions, or a certified financial planner, a registered investment advisor, a CFA. These are people who've earned their degrees, so to speak, and their licensing and registration to be able to advise you financially and manage your money. I mean, those people deserve to get paid, in my opinion. So there's a little bit of balance there. So I give them some pushback on that, and I'd like to break those numbers down with them. I also push back on this idea of creating a science of investing, because here's the thing. Imagine this. Imagine that he creates strategies that are optimal for the market at any given time. Now, if everybody did the optimal strategy, it probably wouldn't work. I mean, when everybody does the same thing in markets, it usually all can lead to wildly unpredictable consequences. And I'll give you an example of some of the stocks I own. Like, I was buying Alibaba this year, BABA, when it was trading $100. When people thought, no, don't buy Chinese stocks, no, don't buy internet stocks, And to me, that the market was inefficient. They were not seeing the potential growth of Alibaba as the Amazon of China. And so now, it's making new highs today above $185. And so would a quant fund, would an AI strategy put you in Alibaba now? Well, I think it should. I think that you still buy it. But then would it still do it, a year or two from now when it's still making new highs and say Alibaba's at 250? That's a time where if everybody's doing the same thing, it chases prices up farther and faster than maybe they should go because everybody is doing the same sort of thing. You get to that point, then you're going to have the smart investors who were buying Alibaba at $100 or Facebook at $125, which I recommended last year, or NVIDIA at $125, or Align Technology, the Invisalign maker, which we just had a fantastic return on. If the people who saw the inefficiency and said, hey, I think this company is worth twice what they're valuing it now, those are the people who are going to start selling to you when you're buying those brand new highs a year or two from now. So there's a little bit to think about there, that in terms of a science of investing, the markets are, I just say they're infinitely complex. And if you read The Black Swan by Nassim Nicholas Taleb, and you understand what he's talking about, he picked it up from Benoit Mandelbrot, this concept of wild randomness. I mean, markets are these incredibly complex social beasts. And so I say they have infinite complexity. And as Taleb and Mandelbrot say, they have wild randomness, or you could call it infinite variance. But the thing is there's so much going on. It's a cauldron. So there is a lot that's unpredictable. You know, as a growth investor, you know, you have to be prepared sometimes to take a step back and question your own methods and biases. So I always get a little worried when somebody says they've got a science of investing because, you know, I gave you the example earlier of me evaluating Tesla a year ago and wondering if it was even worth $200. And now I think it's definitely worth $200. Who knows? I might pay $300 for the stock if the company executes on delivering this Model 3 next year and the sales start to ramp. And this is the beauty of investing if you're a stock picker, is you get to do this research on companies as much as you can. You know, if you can't go visit the company, at least you dig up everything you can on the internet and find out, what is the true growth prospect of any given company, whether it's in technology or energy. Boy, I stay away from energy lately because I realize I don't understand it well enough, and the price of oil seems to have pressure on it that there's so many other things to do with your money besides being an investor in energy companies. And I'm not saying that you shouldn't. I'm just saying that's not my area of expertise and interest, so I stay away and focus on technology and healthcare, which definitely are where the earnings growth is. All right, I better start wrapping this up because we've talked about a lot of cool things. The beauty of what qplum is doing is, giving the individual investor access to some form of deep learning. Not just a quant strategy that a quant invented, but hey, he's training his strategies on data, and I think he'll keep doing it. And all you really need, this is the new age of AI, because all you need is data and then a tool to train your machine. So you look at machine learning and deep learning in two ways. You can either take data and train the machine, or you could actually create a simple algorithm and let it teach itself, which is what we talked about last week with what Google did with DeepMind and the AlphaGo Zero program that has now conquered all other Go strategies, because it just took the board and the rules and played itself millions of games and trained itself to be the best. Now, so that sort of thing could keep changing. But bringing deep learning to investing for the average investor, definitely does sort of lower or level the playing field. Now, one of the thing I wanted to push back on that Gaurav said was that there was no longer a competition about edge. But again, this is where smart investors are going to get edge. Because they're going to look at inefficiencies in the market that maybe even an AI program didn't recognize. That's one thing I'd like to ask him. Would his AI program have always been long Tesla and Alibaba or NVIDIA, with valuations getting pushed? Would it have looked at all the factors? Because one of the factors in investing is also the tailwind of other investors buying. When I say other investors, I mean hedge fund managers. But you also had the pressure of like a Jim Chanos, who's been bearish on China, and I think he was bearish on Tesla too. He was short stocks like Tesla and Alibaba and probably NVIDIA with that valuation. So to me, the edge is still in the stock pickers research. And I did, if you want a 1-minute summary of this, I did a video a couple of weeks over at the SIBO, the Chicago Board of Options Exchange. I go visit Angela Miles there about once a week, usually on Fridays. And she asked me for a trading tip. What's my, if I could offer the people, what's my favorite trading tip? And I actually went big picture. And I said the key to success in this bull market has been following smart money. Well, how do you follow smart money? You find out what they're buying and why they're buying it. And so I'll link in the article on Zacks.com to my 1-minute video on following the smart money and how you do it. But we'll talk more about this next week. I've got so much to share on this. I want to talk about what Google does with their venture capital arm as sort of a model, and I think that's a $1 billion idea. If you just look at what Google does with small companies, they're taking companies out of the market before they can IPO. That's why there's less IPOs, because Google Ventures and other VC firms buy these, the bleeding edge innovations, whether it's in science, technology, healthcare, retail, and they take them out of the market because they want to be the idea incubator and find out what's going to work in the next evolution. All right, boy, this is probably my longest podcast ever, but I hope you liked it. Oh, I wanted to mention the last thing is Robinhood. Robinhood is another platform. They just had big news today. It's been an app on your phone, and it's what the millennials are using to trade. Apparently, you can trade on there commission free. And I don't even know how they do this. I don't know how this company's making money. I want to learn more about Robinhood, but it's because it's app based and it's free. Of course, it's going to attract a lot of people. It's attracting younger people to trade, and speaking to them in their language. Right? If investing is if life is lived through apps. Why not investing? And probably the way they organize the app, is more intuitive and friendly and inviting to younger people. But they've got big news today that they're going to the web now. So they've realized, hey, to expand and grow their business, they actually need to be on the web too, and not just an app. And so cool things happening there. I know they talk about behavioral elements too, but I need to learn more about them. All right, enough AI and investing for today. We're going to we'll do a part 2 on this next week where we'll dive into it and maybe even have some guests. So I will talk to you soon. Thanks for joining me on Mind Over Money.